So good afternoon. This is Fernandez-Niedzielski from Remax Gold, and I am here today with Sarah Lee from Guild. And Sarah and I have met a while back, and now we're actually really collaborating together for bring to the market really what's happening right now. And she's obviously an expert in lending. So Sarah, can you introduce yourself to let us know how long you've been in business and what are you seeing right now?
Hi, Claudia. Thanks so much for having me today. This is a great opportunity to just bring some, information and data to the marketplace. I know that a lot of us are on information overload. I've been a mortgage loan originator for 17 years now. I'm actually going on 18 years this August. So I was around during the 2008 crash, and I would really love the opportunity today to talk about why what we're seeing now is different than what we saw then. As you mentioned, I work for Guild Mortgage. I am a producing branch manager for them. And so I also have the pleasure and the honor of helping other loan officers navigate and grow their business. So we were talking earlier, Claudia, you and I, about what are just some of the significant impacts of COVID-19 on the lending industry. And in terms of what our consumers are going to experience, if they were somebody who needed access to what we would consider a more high-risk lending product, those high-risk lending products have really disappeared. And that's because the servicers of those mortgages, the investors of those mortgages, they are experiencing some real liquidity issues. And so anything that might reek of default, nobody in the lending industry wants to touch right now. And
so a question on that, and sorry to interrupt you, Sarah, but when our audience is listening, so what would you consider a high risk loan at this point? Because obviously some folks may not know what that means, and they may just, for them, they may think, okay, if I don't have a job, then that means high risk. But I think there's more than that now.
Yeah. So a high-risk loan was a loan that we would call a non-QM loan in our industry, and QM stands for qualified mortgage.
Okay.
And so Fannie Mae and Freddie Mac, FHA, VA, those are your standard QM loans, right? A qualified mortgage. We have all kinds of rules that we have to follow to verify the borrower's ability to repay. But since the recovery from 2008, we've started to see more and more lenders offering high-risk products like stated income loans again, bank statement loans again. So, some of these products that would go outside of the Fannie Mae, Freddie Mac, FHA, VA rules on how we document a borrower's ability to repay the loan. And so those products almost overnight disappeared, left the marketplace, and followed shortly thereafter by a lot of the jumbo investors. So I want to be really clear here. The jumbo loans are still available to some extent with what we call retail lenders. So a retail lender is a depository lender, sorry, let me clarify that, depository lender.
Okay.
Somebody who is can open up a checking account with them, a savings account with them. So your banks, your credit unions, a lot of them are probably still offering jumbo loans directly to the consumer. But investors who were allowing other lenders to be a correspondent lender, so somebody who is going to originate the loan, is going to fund the loan from their own money, but then immediately sell the loan to them, right? That relationship is gone. And again, understandably so. These lenders who are lending high-risk products, and a jumbo loan is a high-risk product because they're extending a lot of money to this one borrower, they want more control over the underwriting process, more control over vetting that borrower. So many of the correspondent lenders who were offering jumbo as correspondent, they don't have that anymore. And so it does mean that there are fewer lenders in the marketplace for jumbo loans as well.
So what that means basically is for somebody that is trying to buy a home where it was qualified, let's say in February, what does that do to that borrower? They got qualified in February, they had a jumbo loan in place, and obviously not only the jumbo loans are the ones that are right now in hardship as far as being able to fund, but somebody that was in that market, what does it look like now for them? And then we'll jump into what it looks like for all of other borrowers that are doing, 3%, 5%, 10% down.
Yeah, I would definitely say actually for all borrowers, not just jumbo borrowers, or somebody who was using one of those non-QM mortgages I was talking about, anybody who was pre-approved in February or earlier should be going back to their lender right now and making sure that their pre-approval is still valid and getting it updated if any of the terms have changed. And if you were a jumbo borrower and you were not getting your loan directly from a depository lender, so a bank or a credit union, you definitely need to contact your lender and see what the plan is. Absolutely.
Okay. So how does Guild is working through this crisis at the moment, Sarah? Because obviously, as each one of us that are in the real estate business, and this is what we do for a living, we have our affiliates that we obviously refer most of our business to whenever we get borrowers. And how are we now as agents, or what would you recommend for all, not only us, but our clients? What do they need to look for when they're looking for a lender in this time of crisis for everybody? And how does Guild, obviously could be the potential best choice right now for a lot of them?
That's a great question. We are expecting a lot of the small to medium-sized lenders to really struggle during this time, because I don't want to get too far into the weeds of this, but the amount of forbearance requests, so that's people who have been taking advantage of the offer to miss these payments, right, while they're unemployed. That is creating a strain on the servicers of those mortgages. Something that a lot of people may not know is that your servicer is not typically the entity that owns your mortgage. So for example, Guild Mortgage might originate your loan and fund your loan and service your loan, but we don't own your loan. There's an investor on the back end that owns the loan, and Guild Mortgage earns a certain fee every year for servicing it. So there's money that we make for servicing that loan every year. But it is the investor behind the scenes who owns the loan and so makes decisions about whether or not to offer that forbearance package to the borrower. But what a lot of people don't also understand is that we have to forward payments to the investor every month. And there is a lot of things in place right now trying to help servicers bridge the gap, because what happens when the servicer doesn't get the payment from the borrower but still has to make a payment to the investor?
Yeah, so that's like in plain and simple English, if we were to break it down, is you make a loan to your neighbor, but you got that money to lend to your neighbor from your parents per se. And now the neighbor doesn't pay you, but your parents are telling you, you still need to pay me that money. So there's obviously, how do you do it when you don't have that money?
Yeah. So there's lots of things that are in place, and it still hasn't all been fleshed out on how we're going to help the servicers. But you can imagine that servicers are pretty nervous about risk, right? There's something else called margin calls, and that gets kind of really into the weeds, and I don't want to get into the weeds, but the bottom line is that to be a successful mortgage bank right now, you have to have a lot of liquidity. You just do. You're going to have to bridge the gap for a lot of things right now. And the small to medium-sized companies may not be positioned to do this very successfully. And it's unfortunate because this really, COVID-19 really, truly, right, an act of God. I mean, nobody's been mismanaging their company. but it really is a time that we're going to see that the companies that have put themselves in a really strong liquidity position are going to be the ones that are able to get through this. And Guild is, well, we've been in business for 60 years, and our executive leadership team is amazing, and they've been planning for this day since 2008. They learned a lot of lessons in 2008. And I'll take this moment to just say that what happened in 2008 in large part was caused by the housing industry and by the lending industry. Mm-hmm. And what's happening right now was not caused by the housing industry. Correct. And so it's very different. I have a lot of people, you too probably, who say, oh my gosh, our value is going to start crashing. Is this a terrible time to buy or sell? And what I say to all of those people is, this is not the same thing. There's very different things at play here. And you can speak to this better than me, but I find that in our marketplace, even if 50% of the buyers were out of the market and not looking to buy, we probably still have too few sellers for the number of buyers that we have in the marketplace. We have an inventory issue in this market. So I think that our industry will remain healthy and strong. That's just a personal opinion. Mm-hmm. That's all that is. But we do need to be able to continue to offer strong lending options for borrowers. So Guild's been doing this for 60 years. We're really well positioned. We have a lot of liquidity. We're going to be able to weather this storm. And there are other large companies that will be able to weather this storm. We've already talked about it, but just to recap, high risk stuff has gone away. Okay. A lot of the minimum credit scores have increased. And that's another reason that anybody who was already pre-approved needs to talk to their lender and update that pre-approval.
So what does that look like, Sarah? What do you now, like if in February you were able to qualify for a loan, let's say, what was the minimum at that point and what is it now? At least even for, that would be good.
Yeah, great question. So in February, let's take FHA for example. In February, that minimum credit score was a 580. And now on a purchase with Guild is a 600. If you're trying to do a refinance, it's gone up to a 640. So these are really big swings in minimum credit scores, which is why you should be contacting your lender to update your pre-approval. The other caveat that I'd like to make is that that increase is going to be different from lender to lender. I know that some of my competitors in the marketplace have raised that minimum credit score to a 680. And so that's, on a purchase, that's a really big swing. That's a 100-point swing in qualifying credit scores.
Well, and what I also read, and sorry to interrupt you, and you probably just spoke to this, I read that Chase, for example, just raised the minimum credit score on a purchase to 700, which talk about a huge swing, and they're requiring 20% down for them to be able to actually lend on a purchase. So what do you, go ahead.
That is my understanding as well. They have a few caveats to that, but that's my understanding as well. Okay.
Yeah, so, and I think that's what we're seeing, and correct me if I'm wrong, the theme that I'm seeing right now is lending in this time of crisis is basically changing, if not by the day, by the hour, and pretty much by the minute. Would you agree on that?
I would agree. I think the most important thing is to be with a lender who has as much control as possible. So, for example, anybody who's not a direct lender to Fannie Mae and Freddie Mac, meaning that they can sell their loans direct to Fannie Mae and Freddie Mac, and Guild is a direct lender. Okay. Anybody who's not a direct lender is at the mercy of they're at the mercy of the investors in terms of what overlays they want to put on them. Guild is only at the mercy of Fannie Mae and Freddie Mac guidelines. But other lenders may be at the mercy of an investor and so those overlays are in 600 and somebody else might be saying 680 for a minimum credit score. So if you want the most flexibility, you want to be dealing with a direct lender. That's the most important thing. So you don't want to be dealing with a broker. You don't want to be dealing with a correspondent lender. You want to be dealing with a direct lender. And that is a question that you can ask of your lender. Are you a direct lender? Are you funding this, right? Are you,
And that's,
right?
Thank you for that, because those are the tidbits that I wanted to make sure that our audience gets. What are they needing to ask at this point? Because I definitely understand that we all have choices, and that choice in this market and in any market is left to the borrower to decide. I know that for us, at least as agents, you know, right now we're put in a position where we really want to make sure that we service our clients to the highest level possible, with the most certainty that we can control at a time where uncertainty is everywhere. So the tidbits that you're giving right now is basically, what are some of the key questions that a borrower right now would need to ask? So you address one. Are you a direct lender? Are you funding this? Am I going to be okay with you and not having any additional overlays? What else?
Right. Which is not to say that guidelines still won't change between the time that they're pre-approved and they go into contract. But it does mean that the company that they're dealing with has the most amount of control over those changes, right? The other question to ask, if you've already been pre-approved, is, has anything changed in what I'm being offered? Right? Like, unfortunately, not every lender will proactively reach out to borrowers who have previously been pre-approved, because nobody really wants to give bad news, right? But it's important news to give. If you no longer qualify because of your credit score, if you no longer qualify because the program itself went away, that's something that you need to know. The other question that's going to be really important right now is PMI. So any of your consumers who were putting less than 20% down, they will incur something called private mortgage insurance. And we are seeing, in fact, just today I read an email from one of the major PMI companies that they are making changes to the cost of the PMI in some of the high risk loan to value groups, right? So for your 3% down, you're 5% down. So that's another reason to make sure that you're getting an accurate picture of what today's terms look like. It's not just interest rates that might be changing, loan terms that might be changing, but the private mortgage insurance companies are also trying to mitigate their risk. So any borrower who's putting less than 20% down, you want to ask questions about, what is the cost of the private mortgage insurance? That's going to have a big impact to the monthly payment.
That's great information, Sarah. And then I had a last question for you, and that had to do with so many, you know, people losing their jobs at the moment, or being on administrative leave, or being on unemployment. How is one to prove that? Well, obviously they're going to have to say that they're unemployed at the moment, but is that going to be able to be counted towards income if they actually were qualified before and now they're on unemployment? You know, how does that look like for some of those people?
I'm so glad you asked that question. You know, unfortunately, and most unfortunately for the borrower who may have been furloughed, even if you are still considered employed by the company, but you are not receiving pay, we cannot qualify you. That's not just a guild thing. That is an industry directive. You know, you're not receiving income. We cannot qualify you. We cannot use the unemployment income as qualifying income. That's temporary income. It is an unfortunate situation, but the moment that we learn that a borrower is furloughed or has been laid off, we have to stop the presses and wait for their employment to be reinstated, and be able to qualify them on actual income earned. It is an unfortunate circumstance that many people are finding themselves in.
So with that being said, Sarah, would you also, or have you seen, and this is something that I learned from a different lender, that, you know, as things get more in depth and the reality of what's happening, and it starts hitting at a, deeper level, that you could be employed today, you could have all your benefits, everything, all your hours, and then tomorrow, obviously, all of a sudden that changes. And so what happens if you were to close, let's say next Friday, and I probably could already tell the answer, but just if everything was going great up to this Friday, and then on Monday you get the notification that says, due to the crisis, the liquidity that you talked about, the company's not able to continue at this pace, so now we will have to make reduction in salary, and you were due to close next Friday on your purchase. What happens then?
They don't get their loan. So one of the other important things for clients and realtors to know as well is that guidance has been changed in most circumstances with most loan programs. We have to do a final verification of employment within 24 hours of closing. That window used to be much longer, 5 days in some circumstances, 10 days in other circumstances, where we could do our final verification earlier in the process. Most of the time, just to get it out of the way. It wasn't a last minute hustle, right? We were trying to track down their boss. But that has changed specifically because of what you just described. We have people that are employed this week that may not be employed next week. And so 24 hours, within 24 hours of closing, we have to do a final verification. With my clients, I'm asking them in the very upfront of the process, please give me the best contact for your supervisor who can complete this. And please understand that it has to be done in this window. So who's the best person who can be most responsive in that window? And they will be asked if you are currently still on the job, working and receiving full pay. And the answer to that question is no, then we can't fund the loan. And quite honestly, that's probably in the best interest of the client as well, because if you just lost your income, the pressure and the responsibility of a new mortgage might not be the best thing.
Right. All right, Sarah. So just in closing, I know that this is obviously what may appear as a doom and gloom conversation, but it's what's happening, it's a reality. And I believe, that the more we sugarcoat it and the more that we try to actually swing it, I understand that there is positive messages out there. There's still lending happening. There's still people that are buying. There's still inventory shortage. You talked about that. We still have multiple offers on the market. We're seeing that. So what can be a positive shiny light as we close our call? What are you seeing there?
I'm glad that you want to end on a positive note, because there is still a lot of positive to be had. So for example, down payment assistance is still available. So we had a small little window where it wasn't as the very onset of all of this, we were trying to clarify some things with those agencies, but those, I'm very, very happy to say, have come back on board for the most part, most of those programs. And so down payment assistance still available. And for the most part, those staple loan products that most people are using, your 30-year fixed mortgages, even with 3% down, 5% down, FHA, VA, all of these things are still available. Yes, there are some increases to minimum credit scores in some scenarios, but quite honestly, still very accessible. And we're not talking about, like you mentioned, Chase with their 700 credit score, right? We're not talking about credit score increases that dramatic. So lending is still very accessible. There is some, last minute things that we have to make sure that we're verifying, like that employment. But for people who have been able to, regain or retain their employment, they're probably not going to see a limitation on what's accessible to them. Really, like we started off in the beginning of this call, it was those borrowers who are relying more on the high risk stuff that are going to see a lack of access to lending. But people who were not in that category, it really, we're still here. We still have money to lend. And maybe we have to jump through a few more hoops to get you there, but we can still get you there. So, go look at those virtual open houses.
Well, that's a wonderful positive note to end in. And so just to kind of gather it all and correct me if I'm wrong on what I say, make sure that the questions are from your lender. Are you a direct lender? You know, are you going to be able to handle the loan, fund the loan, and are you not having any additional overlays? Are you know, making sure that you're reaching out to a lender that you know that has liquidity in the market. And if you're a borrower that were to be pre-approved in February, that you check back in with your lender as you're continuing with your process. For the borrower that was actually in a high risk position, more likely that will not be a loan that would be now able to fund in any of the services that are currently offering loans. And to make sure that you are still employed and at least know to the best of your ability, which I know that right now that's extremely hard, and really to understand that there's still a great deal of money to be had out there for those that qualified with
and at historically low interest rates.
And the rate, yeah, the interest rates. Perfect. Well, so what is the interest rate today, Sarah? Now that you talked on that.
Yeah, that's a difficult question to answer, because I always tell people that's like asking a pizza place, how much does your pizza cost? Do you want a large? Do you want a small? Are you ordering a cheese pizza, a combo? So the rates do vary depending upon the loan programs, but I will tell you most all of them are still in the mid to the low threes. And you know, your credit score can impact that and raise it. You know, all kinds of things can impact it. How many toppings are you going to put on that pizza? But they are historically low. And so again, lending remains very accessible.
Perfect. Well, thank you so much, Sarah, for being here with me. I truly appreciate your time and your knowledge. And I will make sure that I do share this with my audience and make sure that I have your information handy for anybody that is just trying to reach out and probably even just have a second opinion. So thank you so much. And we will be seeing you on the market. You are so welcome. Take care, Sarah.
Bye.
Bye.